Most people believe that when a market crashes, wealth disappears. That's not actually what happens. What really disappears is comfort, certainty, and the illusion that prices only go up. Wealth doesn't vanish, it moves. And almost nobody pays attention to where it moves or why. If a major market downturn arrives in 2026, the outcome will not be decided by intelligence, luck, or courage. It will be decided by incentives, behavior, and time horizons. The same forces that quietly create wealth in stable periods become obvious during crashes. Most people still ignore them. Market crashes feel like failures of the system. In reality, they are corrections of expectations. For years, prices rise faster than fundamentals. Debt expands faster than income. Risk feels smaller than it is because consequences haven't shown up yet. Eventually, reality catches up. That moment is what people call a crash. The key thing to understand is that crashes are not equal opportunity events. They punish specific behaviors and reward others. They punish leverage that assumes stability. They punish short-term thinking that depended on constant liquidity. They punish narratives that replace cash flow with hope. At the same time, crashes reward patience, optionality, and control. They reward people who design their lives and balance sheets to survive bad outcomes, not just benefit from good ones. Most people misunderstand this because they focus on prices instead of systems. They watch stock charts, housing prices, crypto valuations. They don't watch incentives. They don't watch balance sheets. They don't watch who is forced to act and who is free to wait. In every crash, the real winners are not the people who predicted it. They're the people who don't need to sell when others do. They're the people who can deploy capital while others are protecting themselves. This is where long-term thinking quietly dominates short-term intelligence. In a downturn, the most powerful position is not optimism or pessimism, it's liquidity combined with patience. Liquidity gives you choice. Patience gives you pricing power. Together, they let you buy assets from people who don't want to sell but have to. That's uncomfortable to hear, but it's how markets work. When asset prices fall, it's rarely because the assets became useless overnight. It's because the owners lost access to time. Debt payments still come due. Operating costs don't pause. Investors want their money back. Fear accelerates decisions. Forced selling creates discounts, not because value vanished, but because time did. Most people approach crashes emotionally. They ask, will this recover, or is this the bottom? Those questions miss the point. The more useful question is, who is under pressure right now and why? Pressure reveals opportunity. In 2026, if markets contract meaningfully, you should expect three broad dynamics. First, capital becomes selective. Easy money disappears. Projects that relied on constant refinancing stop working. Businesses with weak margins are exposed. Second, narratives lose power. When liquidity dries up, storytelling doesn't pay bills, cash flow does. Third, ownership consolidates. Assets move from leveraged hands to patient ones. This is not new. It's how every modern downturn has worked. The mistake most people make is thinking wealth is created by timing the bottom. It isn't. Wealth is created by positioning before the crash, not reacting during it. By the time a downturn is obvious, most advantages are already locked in. Prices may keep falling, but behavior has already shifted. Banks tighten lending, employers slow hiring, consumers reduce spending. The system becomes defensive. If you want to benefit from that environment, you don't need predictions. You need structure. Structure means low personal leverage. It means expenses that can be reduced without destroying your life. It means assets that produce cash instead of consuming it. It means skills that are useful when budgets shrink, not expand. Most people chase upside during good times and hope to survive downturns. That's backwards. The correct approach is to design for survival first and let upside take care of itself. This is where the idea of getting rich in a crash becomes misunderstood. It doesn't mean sudden wealth. It means acquiring durable assets at rational prices when others can. During crashes, high-quality businesses don't disappear. They become temporarily mispriced. Real estate doesn't stop being useful. It just changes hands. Infrastructure, logistics, energy, basic services, demand doesn't vanish. Ownership changes. People ignore this because crashes feel chaotic. But beneath the surface, incentives become clearer than ever. Governments prioritize stability. Large institutions prioritize survival. Individuals prioritize safety. Each choice creates predictable outcomes. Another misconception is that opportunity only exists in public markets. In reality, many of the largest transfers happen quietly. Private businesses sell at discounts, partnerships dissolve, competitors exit markets entirely, labor markets reset, changing who can build and who must wait, crashes compress time, trends that would take a decade happen in 2 years, inefficient players disappear faster, strong players gain share without growing. This matters because wealth is not about growth rates. It's about ownership of systems that endure. Most people spend their energy trying to forecast prices. Very few spend time understanding resilience. They optimize for returns, not for staying power. When conditions change, they're forced to react. The people who benefit most from downturns rarely look like geniuses in the moment. They look boring, conservative, underexposed, sometimes even wrong. Until they aren't, long-term wealth is built by consistently doing reasonable things while others swing between extremes. Crashes amplify that difference. If you zoom out far enough, markets reward those who think in decades and punish those who think in quarters. A downturn doesn't change that rule, it enforces it. What makes 2026 potentially dangerous is not the crash itself, but the complacency before it. Extended periods of stability train people to ignore risk. They assume tomorrow will look like yesterday. They mistake recent history for permanent truth. That's when incentives quietly stack against them. You don't need to assume disaster to prepare for it. You just need to accept that cycles exist and that pretending otherwise is costly. The uncomfortable reality is that most people will experience the next crash as a loss, even if nothing fundamental about their lives changed. They'll sell because they're scared, not because it's rational. They'll avoid opportunities because uncertainty feels worse than regret. A small minority will do the opposite, not because they're braver, but because they planned for this environment years earlier. That's the real dividing line. In the end, market crashes don't make people rich. They reveal who already built the conditions to become rich. They expose who depended on optimism and who depended on structure. And they remind everyone that wealth is not about predicting the future, but about being prepared for it. That's a lesson most people only learn after it's too late.